On this episode of What's Going On with Shipping, it's the May 18th, 2022 edition of What the Ship. Welcome to this episode of What's Going On with Shipping. So, 5 stories from around the world in the field of shipping. Everything from situations in the Black Sea to trade to an event that just took place in Washington, D.C. that is 80 years in the happening. So I'm going to be happy to talk about that story at the end. If you're new to the channel, take a minute, subscribe to the channel, hit the bell so you'll be alerted about new videos as they come out. All right, let's jump to story number 1. So story number 1 deals with the container trade, something we've talked a lot about on this channel. And this story from GCAP and from Lodestar, U.S. container imports jump in April as coastal shift continues. So we've heard a lot about inflation and the slowdown in consumption of American consumers. However, that's not being accurately reflected in the transportation of goods from Asia and around the world to the United States. And this Lodestar story reflects on that. If you jump in here, the 7-week COVID lockdown in Shanghai prompting carriers to blank, in other words, cancel a third of export sailings on the Asia, Europe, and Trans-Pacific trade lines is creating a lull in May import volumes throughout U.S. West Coast ports. Moreover, the coastal shift by shippers from the West Coast to the East Coast appears to be gaining fresh momentum ahead of the expiry of the U.S. West Coast labor agreement on 1 July, despite some optimisms from both the unions and the employers. So if you jump down, they're looking at the numbers put together by John McCowan over at the Blue Alpha Capital Group, who does this monthly report and takes a look at the differences. But I want to jump down here to the bigger issue. Combined U.S. East Coast ports saw laden import throughput of 1.148 million TEUs in April. That's 18.7% higher than that year before. In contrast, a volume of 1,041,000 TEUs at the top U.S. West Coast ports represents a 3.4% deficit. So in other words, we're seeing an increase, marked increase this year on the East Coast. It says right here, Savannah up 11%, Houston up 26.5%, Charleston up 34%. Meanwhile, on the West Coast, Oakland down 15.8%, Seattle, Tacoma down 20.1. The one exception on the West Coast that we're seeing growth in, and it's mentioned here, is in the port of Long Beach, where we see Long Beach increasing. LA is down 459,000 containers, 6.2% down, but Long Beach is up 9.2%. Why is Long Beach up? The LBCT terminal is automated and it's running at full capacity and it's a much more efficient port. Plus, they've just completed a rail addition into Long Beach, and Long Beach is going to surpass potentially LA as the biggest container port if things keep going the way they are. Now, this raises an interesting question that's over on FreightWaves by Greg Miller. Has the peak of container shipping epic boom already passed? This goes to a statement from the CEO of Hapag Lloyd, who says that the market peaked back in the first quarter. And of course, any Greg Miller story will have some great graphs and charts that shows this, that looks at these different areas on the graph. As you see right here, they're using their sonar data to track the different spot rates from Shanghai to Los Angeles. But one of the things that, again, you have to note is, yeah, they're down from that peak at the end of 2021, even down from the high at the beginning of 2022. But man, they are still substantially higher than what we saw going all the way back into 2017. So while rates are down, they're pretty damn high. And those rates are going to remain. Yeah, Hapag Lloyd, which reported a net income of 4.7 billion for Q1 2022 versus 1.5 billion for Q1 2021, is sitting there saying, well, we're going to be down in Q2. Well, yeah, but look how high you are compared to where you were a year ago. That's the big story. And even here, we see this is with another Greg Miller story. Container shipping rates still sky high, but falling back to earth. Well, I don't know, Greg. They're falling, yes, but are they falling back to where they were? Don't think so. And I think that's what we're seeing here with freight rates coming down, container spot rates coming down. Again, you're seeing this back to October of 2021, go back to October of 2019. Those rates are a heck of a lot different. And it's all in how you represent the data. Freight rates are still up high. Look at this. This is the cost per TEU. Again, this goes back to early 2021. But again, you got to go back to prior to that, 2020, 2019, to see freight rates down below 3,000, way below here. So yeah, they're dipping down the North Asia to the West Coast, the North Asia to the East Coast. They're coming down from the peaks they were at, but man, they are still high. And these blank sailings, these canceled sailings are really important. If you're a shipping company and you make six, you envision making 6 runs a year with a ship, and now you're only making 4 because of delays at Shanghai, delays in ports. It's taking you 2 weeks if you got a Neo-Panamax ship to get through the Panama Canal. If you're making 4 runs versus 6, you're going to increase your freight rates. You're going to increase the cost to make up that difference. And what we're seeing here is we're still at high levels with ships waiting to get in at Long Beach. The last number I looked at was just under 30 off LA and Long Beach. And if you look at the chart here for 2021, what happened in the second half of the year of 2021, the numbers started going up. If Shanghai fully opens, if the other Chinese ports open, if there's still doubt about the ILWU contract renegotiation, this is going to go up. But what we're seeing is a lot of these ships that would be waiting off LA and Long Beach now are going through the Panama Canal and are going to Charleston, Savannah, Norfolk, New York, New Jersey, Houston, other ports. And that's the big difference we're seeing right now with container shipping. It's going to be interesting to see exactly how this all plays out. We don't know yet. We're still waiting to see. There are a lot of variables out there in the market. But when you hear that things are coming down in ocean shipping, you got to be careful. You got to use relativity when studying that. We're coming off of Mount Everest in terms of freight rates. We're still, well above the tree line coming down off of Mount Everest. It's still dangerous. And that's the thing we got to keep looking at. All right, let's jump over to story number 2. Story number 2, food. Food is becoming the big issue we're going to be watching over the next year because of what's going on in Russia, Ukraine. The amount of food that's coming out, that's being exported, is becoming an issue. I had an interesting conversation on Twitter yesterday with a very knowledgeable expert in the field of oil. And I've made the comparison, you've seen it in a previous video I did, and you can catch it right up here, that I've compared the Black Sea to potentially the Persian Gulf of the 1980s. And what's interesting we're seeing is a lot more trade going across the Black Sea. China just announced its rail service that it had created across Euro-Asia continent. It had a massive railway service that went from China across Russia into Europe, which has now been curtailed because you're not getting trains out of Russia anymore. They're now diverting that down through Central Asia with a terminus on the Black Sea, and then across the Black Sea to Romania to continue its route. So you're actually having Chinese cargo and freight moving across the Black Sea, something we thought we'd never see before. But food is becoming the big vital issue. And in an earlier Twitter kind of thing, we had this discussion with an agricultural scientist who sat there and said, there's no worries about Ukraine not exporting, even though Ukraine exports 10% of the world grain, because countries like India will pick up the slack. Well, then this story hits. India's surprise wheat export ban traps 1.8 million tons at ports. India's wheat export has trapped some 1.8 million tons of grains at port, leaving traders facing heavy losses from the prospect of selling onto a weaker domestic market. New Delhi banned wheat exports on Saturday, just days after saying it was targeting record shipments of 10 million tons this year as a scorching heat wave curtailed output and domestic prices hit a record high. But of the around 2.2 million tons of wheat currently at ports or in transit there, traders have LC's letters of credit for only 400,000 tons, a Mumbai-based dealer with a global trading firm said. Exporters don't know what to do with the remaining 1.8 million tons. Nobody thought the government would outright ban the exports. This has created havoc. Understand, India has a lot of problems in exporting grain. They don't have good ports. India does not. If you look at the top 30 ports in the world, India only has one. They are not great for their ports. Also, you have to get the right size vessels into those ports to transport that grain to smaller ports around Africa, the Middle East, and Asia, typically what you would get out of Ukraine. All this, suffice it to say, is that now we're going to have food shortages, and food shortages create pandemonium in countries. Now, understand, we're not getting a food shortage in the United States. That's not what's happening. You're not getting a food shortage in a lot of countries around the world. This tends to be in countries with lower end, below the G20 countries, that we're going to see this. And this is going to cause disruptions. Food prices are going to spike. In the United States, we just are experiencing a shortage of baby food because of the shutdown of a baby food plant in Michigan, and then tariffs on baby food imports from the previous administration have all caused this issue. It doesn't take much to trigger shortages, particularly in the area of food. And once you start talking about this, people panic buy and it gets worse. Add to this, Ukraine asked Turkey to ban stolen grain cargoes from the Bosporus. So I just did a video the other day, again, I'll have it right up here for you, about a Russian bulker that had stolen Ukrainian grain on board. The Ukrainian government protested about it. The cargo was heading to Alexandria, Egypt. The Egyptians agreed not to accept the cargo, so the ship diverted to Syria, where the cargo was offloaded, and now it's going to be distributed, because once you unload it, who knows where the grain came from. This is becoming a bigger and bigger issue, because what does Turkey do with regards to the transit of cargo through the Turkish Straits? There was a report about Russian military equipment being sailed through the Turkish Straits to reinforce the Black Sea on commercial vessels. What if Turkey decides to impose an embargo against Russian ships hauling Ukrainian grain? What if NATO forces start stopping ships coming through the Bosporus and the Dardanelles to determine whether or not that grain is Ukrainian or Russian? This, again, has the potential to blow up into bigger issues. And food is becoming like the oil. Yes, oil is, food is we got this issue about, oil's not fungible, it's unique, whereas food, you can grow food anywhere. Well, yeah, largely you can, but you can't grow it everywhere, because if you could grow it everywhere, you wouldn't have to import food into your countries. And that's the issue we're seeing. Grain and food, bulkers versus tankers, are becoming the potential point of conflict, particularly in the Black Sea, in the Mediterranean, in the Indian Ocean. It has that potential. Is it going to happen? I don't know. But I'm just raising that concern, because if it does happen, we need to be prepared for it. All right, let's jump over to story number 3. Next story takes us to the world of oil, and diesel fuel and gasoline is what's driving everybody crazy right now. So, Captain's story: flotilla of tankers take Russian oil through the Suez Canal to Asia. So, Bloomberg story: Russia's seaborne crude exports from its western ports to Asian countries, predominantly India and China, rebounded to more than 1 million barrels a day and could rise higher when destinations are finalized. In the east, flows of the Sokol grade have dried up, with sanctions starting to bite. Overall, crude shipments were virtually unchanged in the 7 days to May 13th, though as European Union nations continue to wrangle over a planned ban on Russian oil imports in the wake of the country's invasion of Ukraine. A total of 35 tankers loaded about 24.9 million barrels from Russian export terminals. That put average seaborne crude flows at 3.55 million barrels a day, down by less than 0.5% against 3.56 million barrels a day in the week ended May 6th. And so what we're seeing is Russian oil is still flowing. And it may not be flowing to where it used to in the past. It's flowing to other areas. And more importantly, even Europe is having a problem of getting themselves off this. This story right here: seaborne oil as a lifeline, as German Polish refiners swerve Russian supply. This is, again, another Reuters story. Seaborne oil has thrown a lifeline to refiners in eastern Germany and Poland, with non-Russian deliveries into the Polish port of Gdansk hitting at least 7-year highs this month as they switch away from Russian supply. Imports booked for May into Gdansk from Egypt, the US, Norway, Britain, West Africa had hit 8.4 million barrels by May 16th, their highest level according to whatever that is, tracking data that goes back to 2015. At the same time, Russian crude booked for May into Gdansk and the port of Rostock stood at 700,000 barrels, down from a high of 12.9 million in May 2019. Non-Russian seaborne crude volumes toward Gdansk have increased at the expense of Russian barrels. So we're seeing Germany, Poland trying to get oil from other sources, including the United States, which is helping cause the diesel shortage we're seeing in the Northeast. Add to it this story right here, EU gives companies green light to keep buying Russian gas. The European Union said companies could keep buying gas without breaching sanctions as it softened its stance in a standoff with Moscow over energy supplies. The European Commission sends revised guidelines to member states on Friday. Goes on here, EU sanctions do not prevent economic operators from opening a bank account in a designated bank for payments due under contracts for the supply of natural gas in a gaseous state in the currency specified in those contracts. Operators should make a clear statement that they intend to fulfill their obligations under existing contracts and consider their contractual obligations regarding the payment already fulfilled by paying in euros or dollars in line with the existing contracts. All this means is that in the European Union, while they're trying to get oil, natural gas is another issue. And this has all been part of the issue that Europe has with severing themselves from Russia. It's very difficult. Now, it's having an impact on Russia, and you'll see it here in these stories. Iranian oil exports to China on the rise. While the West is distracted by Russia, Ukraine, Iran is taking advantage of this, and we're seeing Iranian oil out there. This Sea Trade Maritime news stories. China's determination to bring Iran into a sphere of influence and Iran's increasing ability to evade international sanctions on oil consignments due to the crisis in the European theater mean the Islamic Republic is likely to become more brazen over hydrocarbon exports in future. This is what we're seeing. Again, China wants to diversify where it gets its oil and gas from. And this is part of their Belt and Road Initiative to diversify in this area. Same thing, India is ramping up with Russian imports. This story by Sam Chambers follows along. India's close ties with Russia has seen it ramp up purchases of bargain commodities in the 2.5 months since the invasion of Ukraine began. India's seaborne crude oil imports surpassed 4.8 million barrels per day in April, the record on highest. And so India taking advantage of this. And then you have this story, which is really an interesting one. Sovcomflot, which is the largest Russian tanker firm, ship sales start to emerge. Sovcomflot came out on Friday publicly stating it was looking to sell some of its older tonnage, but dismissed earlier reports that up to 1/3 of its 122 strong fleet was being put on the chopping block as it wrestles Western sanctions that limit repaying outstanding loans and make operations very hard with class and insurers, shunning Russia's largest shipping line. A lot of talk that we were going to see Sovcomflot go under along with some of these other Russian firms, but so far not the case. Instead, they're doing very much what we saw with the cruise lines during the beginning of COVID, when they're bleeding off older tonnage, getting rid of unproductive vessels so that they can keep the core of their vessels operating. And now with the EU Commission and particularly the Greeks pushing this idea of allowing these Russian tankers to keep moving, that's going to cause even more issues going forward. So the sanctions, which were going to bite into Russia very strongly, are not quite having what everybody expected. Russia is diversifying. They're selling their oil to other places. And because of the world market and the fact that OPEC's not increasing exports and issues in the United States over refining, you can't really replace that Russian oil. And instead, that Russian oil is still being sold on the open market. All right, let's go to story number 4. Story number 4 is an editorial piece by Craig Fuller over at FreightWaves. Free trade is dead. Welcome to freedom trade. And, Craig really hits on some key topics every now and then. I think he's really thought-provoking in what he puts out there. And I like that he takes chances with what he writes. He goes out on a limb. Not many writers, let alone CEOs, do that, at least not out in public. And he put out this piece, which I think is really thought-provoking. And I want to read part of it here. American enterprises and consumers should move away from Chinese dependency and demand that supply chains are oriented toward what I call the freedom trade, a system built on the idea that the rule of law, domestic free markets, human rights, and environmental standards are necessary for global prosperity and peace. Supply chains operate best when there is predictability and peace. And the only way to guarantee that is to ensure that countries operate within the freedom trade system. He talks about post-Cold War prosperity for much of the world, particularly the 30 years since the fall of communism, or more importantly, not communism, but the fall of the Berlin Wall and the collapse of European communism with the Soviet Union and Eastern European blocs. It still exists today. But he talks about this. Capitalism spread wealth far and wide, benefiting nearly every civilization and country. Living standards increased unprecedented levels. We, for a long time, being the historian's going to come out here for a second. For a long time, we thought the Iron Curtain kept, communism out from getting into capitalism. What we later found out is that the Iron Curtain kept capitalism from falling into communism. Nobody wants to be a communist once you live in a communist system. They don't. They want to live in a capitalist system. They want what capitalism has. And that's what we see happening here. This goes on here. The United States played global policeman. We weren't perfect, but the international order was far more predictable than during the great power near-peer conflicts that plagued the past half centuries. Great number of books out there on them by Eastbrook and Bruce Jones, The Blue Age, How to Rule the Waves, all those books out there that talk about this idea of how important the U.S. Navy has been to create this international marketplace or international highway on the world's oceans. I will note it's not just the U.S. Navy, the British Navy, the Australian Navy, French Navy, tons of navies have done this to create this. But this goes on to this section, the world economy since the end of the Soviet Union. Since the breakup of the Soviet Union, America's primary expectation of and for other countries was to allow global commerce to proliferate. If a country participated in the US-led international trade regime, it gained far more than it gave up. Goes on here, this is first seen in Germany and Japan, which are third and fourth largest economies on the planet, or fourth and third largest economies on the planet, with China being number two. When nations joined the American free trade system, they are expected to create open and free markets at home. Countries were also expected to ensure standards for human rights, the environment, rule of law. There are common and advanced Western-oriented economies. All right, I'm going to take a little bit of exception here with what Craig's saying on this point. We backed certain countries that were not adopting this. And matter of fact, we've used their economies to our advantage. If you're wearing something made in Bangladesh or Burma or Cambodia or who else knows where, we back some really not great countries that were open and free market, that they were basically dictatorships. And unfortunately, there's a lot of marks on this. You can't make a clean picture of this. You really can't. But I understand what Craig is trying to say in this. And for the 20 years after the fall of the Iron Curtain, the proxy power of America's free market worked exceptionally well. And again, I don't know if I'd say America's free market, but I'd say the free market in general. But then the People's Republic of China does it differently. China, which suffered under some of the most incompetent and unjust leadership in the period from 1949 through the Cold War, Cultural Revolution, anybody, began to ascend from an impoverished backwater to a world economic military power. From 2000 to 2010, China's GDP quadrupled. And that's true. If you look at Chinese shipping, for example, if you bought a Chinese ship in the 2000s, it was, or prior to 2000, it was terrible. It was not good. From the 2000 to 2010, got better. From 2010 forward, man, it's comparable up there with ships being built in China and Japan and Korea. But as China became wealthier, the American version of the free market became far less appealing to the Chinese Communist Party. The CCP wanted American free market prosperity, but without offering the rule of law, domestic free markets, human rights, or environmental standards. Just to be clear, we kind of wanted it too. If you have an iPhone, which I don't, by the way, but if you did have an iPhone and it was made at Foxconn or some of those companies, those aren't really great human rights companies. Let me be clear. Goes on here, the U.S. paid a massive price for allowing to China to have its cake and eat it too. America's working class was hollowed out as jobs and production was outsourced to Chinese manufacturing. In the terms of merchant marine, you see that. Our shipping went to flags of convenience, Panama, Liberia, Marshall Islands. Ships were built not in the US anymore, but in Europe, and then to Korea, now over to China. You just see it going on here. But he goes on here, when China locked down roughly half its economy, exposed the world to a disturbing reality. The more dependent we are on Chinese supply chains, the more vulnerable the American free market system is, thus endangering peaceful trade and global prosperity. When you look at China shutting down during COVID, when COVID initially hit and you saw lockdowns, the world was locked down. When Yantian shut down, the world was shut down. When China locks down now, the world is not locked down. The world's open now. And now we're seeing the impact of what happens when China shuts off its trade. It has an impact on everybody else. And this is the problem of being overly dependent on one economic system to fuel a larger economic system. And one of the reasons I talk about why the US needs a core commercial shipping fleet is so that if you lose a chunk of that shipping fleet because of national issues or a company sanctions you, you have the ability at least to replace part of it and therefore go on. I just want to end on what Craig says here. Therefore, freedom trade demands that autocratic regimes stop trying to manipulate the markets in which they operate. Otherwise, they artificially impact the supply chains that global businesses depend on and can cause great damage to the entire freedom trade system. And since the supply chains prosper when all parties have a mutual understanding and aligned goals, the world will once again enjoy supply chain prosperity and transparency. I maybe a little bit too pie in the sky for my take, but I think it's appropriate for talking about diversifying and ensuring that we're not overly dependent on regimes, especially pretty hard regimes, on personal. Ask the Uyghurs, if you can find a Uyghur. Ask the people of Hong Kong. Ask what happens to Taiwan if Taiwan falls under the economic control of China. That's what you're seeing. And you're seeing the impact of that with Belt and Road initiatives in a lot of countries around the world where the Chinese extract minerals, resources, port concessions, other concessions, and really don't give everything back to them. And you're really creating a unique system out there. And I think Craig hits on a very key topic. I thought it was very thought-provoking. We talk about freight rates and tonnage and ships all the time, but you really need to think about the system and the system we operate on. All right, let's go to the last story for today, and it's my favorite. Story number 5 takes us to the halls of Congress and the awarding of the Congressional Gold Medal for World War II United States Merchant Mariners. This is presided over by Speaker of the House Nancy Pelosi and the Senate Majority Leader Mitch McConnell, along with some other key members there. Representative John Garamendi was there. The commander of Military Sealift Command, Admiral Wetlaufer, was there. The acting MARAD administrator, Ann Phillips, hasn't come on yet, but Lucinda Leslie was there. And this was a process that has been begun under a group called the American Merchant Marine Veterans of World War II. And the effort here was to award a gold medal to those surviving members who had served in the Merchant Marine in World War II. I'm just going to play this in the background as they bring the flag in opening ceremony. I have the link in the story notes here to C-SPAN so you can watch the whole event. During World War II, U.S. merchant mariners suffered atrocious casualties. 733 ships, 9,500 mariners were killed. You had a 1 in 26 chance of dying if you sailed on a merchant ship in World War II. That makes it more dangerous than being in the Army, Navy, Marines, or Army Air Forces in World War II. Now, that number is a little bit off too, because they don't include shipyard workers and office workers, but these are civilians. These are civilians. Initially, to go in the Merchant Marine, you had to be 18 years of old. They eventually lowered that down to 16 and a half years of age. Not sure where the half came in, but they did. And these were civilians that were in the war fight, including cadets. 142 cadets from the U.S. Merchant Marine Academy were killed during World War II. The Merchant Marine Academy at Kings Point is the only academy allowed to fly a battle standard because they lost cadets during the war. The Navy Academy, the Army's Military Academy at West Point, none of them lost cadets or midshipmen in World War II, but the Merchant Marine did. And this event here was really long in coming. Understand, merchant mariners were basically trained under an entity called the U.S. Maritime Service. It was created under the Merchant Marine Act of 1936. It was an amendment to it in 38. And the Maritime Service was meant to train merchant mariners, but also put them into a quasi-military organization that today exists under the Secretary of Transportation. At the end of World War II, they were supposed to be given veteran status. Franklin Delano Roosevelt, who oversaw the Merchant Marine Act of 1936, basically announced that they would be given veteran status. Same thing, GI Bill, everything that went to the military would go to merchant mariners. That didn't happen. As a matter of fact, it wasn't until 1988 that merchant mariners got any sort of veteran status at all. And even then, it was very hard for many mariners to get it. I'm saying that's 40 something years after the war was over. Today, they had a couple of merchant mariners at this ceremony to receive the medal on behalf of the Merchant Marine. Go forward here. That's Dave Yoho, who is a fantastic speaker. And if you ever get a chance to hear Dave Yoho give a talk, which he does here, I strongly recommend you tune in for it and see it. This is the actual awarding element here at the end of the ceremony. I wanted to bring it up here so you can see it. But that is the gold medal that's being held right there that they're basically doing the award on for the ceremony. It was a great ceremony, a lot of history in the ceremony. They discussed a lot about what the Merchant Marine did in World War II. My comment about it is this. As much as they talked about what the Merchant Marine did in World War II, I wish they would have as much of a conversation about what the U.S. Merchant Marine does today and the role they have. Merchant mariners were wounded, sacrificed, gave their lives in other conflicts beyond World War II. I've done a study on the U.S. Merchant Marine in Vietnam, for example, and we've seen ships sunk in Vietnam, merchant mariners killed in Vietnam. They served in the Persian Gulf War, in Korea, Somalia, you name it. And unfortunately today, the 733 ships sunk in World War II, grand total of deep draft U.S. merchant ships today in international trade and the Jones Act trade is 178 based on MARAD's latest calculation for January of 2022. And unfortunately, the U.S., along with other countries, have suffered. There's a lot of reasons why the Merchant Marine has declined. Catch out my video up here on the decline of the Merchant Marine, but it's not just things like the Jones Act, because Britain doesn't have the Jones Act, yet the British Merchant Marine has declined. So has the French, Germans, Italians, the Netherlands. There are other reasons behind it. Yet if you look at some countries like Japan, Korea, China, they have both large navies and large merchant marines and large shipbuilding. And that's because of a lot of policies and provisions that are put in place to incentivize shipping and shipbuilding in a country. Hope you enjoyed today's What the Ship. If you did, take a moment, subscribe to the channel, hit the bell so you'll be alerted about new videos. Leave a comment, give it a thumbs up, share it across social media, and if you can, contribute to our Patreon page. That allows me to bring videos like this to you. We're going to big development over this summer. We're looking forward to and changing a lot of what we do here on What the Ship. We're going to reorganize our Patreon page, do some special things for our patrons, or patrons, I should say, on there, and also do a little bit more in regularity of getting our information out. I'm looking forward to working on it this summer. Until the next episode, Sal, signing off.